today, though, I thought we'd take a look at the Australian Stock Exchange. Yes, the listed company that runs the markets here in Australia. It reported a total capital raise. This is for the markets for the last financial year, or in June, $4.3 billion. That's down 80%. Cash markets average daily number of trades down 26%. Average daily value of trading was down 19%. Average daily futures volume was up 4%. Now, this is where the stock exchange makes its money, of course, on trades, on listings, new listings that come on to the ASX through capital raising. It is the market, just like a property market or a cattle auction out in the bush. Less cows you push through, depending on what the price, determines what the stock agent is going to earn out of it, all their commissions. Well, the stock exchange does that for the share market. Grady, what did you think of the update, and what's the flow through to the ASX?
The thing is, we need to take into account the last 2 years have been 2021 was an extremely big year for IPOs, a record year, 240 IPOs in the year. So that's a lot of money generated for the ASX. And then 2022 had, I think, about 80, but I'm not too sure. But I know it was 2 strong years, really strong years of capital raisings, really strong years of IPOs. And then the market has extreme volatility. So unfortunately for the ASX, this is not a great reading, but it's kind of an uncontrollable. People are less likely to capital raise at the moment. There's no IPOs going out. I think there's been 10 this year to date, or 10 or 11 this year to date. So it's honestly, it's an external factor. It's an external driver. It's unlucky for the ASX. But again, we need to take into account other things.
But in the last financial year,
yeah,
the ASX 200 was up 10.1%.
Exactly.
So the market's actually doing all right.
It's doing well, and I think a lot of companies are really staying away from IPOs because they're just so scared of the reception at the moment, and also capital raisings. But the companies that are there and have a proven track record, profitability, are generating funds, that's what investors want to see. Yeah. And so investors are really hungry for the tech stocks again, for example, which is high growth, affordability for capital raisings, and understanding all of that. But then the thing with ASX we need to also take into account is the companies, the blockchain and tech stack that they've put all the capital and all of their allocation resources focused on. Now they're considering the other solutions for the CHESS placement because the original design is no longer viable. So with that in mind, that's another priority they need to focus on and kind of find a solution for. And then also increasing pressure from competitors like SIBO. So there's a few different factors at play, a few headwinds for the ASX, but I do go with a hold rating just because, again, this result today is on the back of 2 really strong years. So
okay, so a hold from Grady and Bell. Mark Morgan, you look at that 5-year chart, you know, it's down near a 5-year low at the moment, the ASX.
And based on their justification, it should be lower.
Right.
So the ASX, there's a lot to like about it. It has a near monopoly position in parts of their business. Yeah. It has a very, very stable earnings. In fact, we've got a 97.7% stability of earnings, but only at 2.7% growth rate average. So in other words, earnings have been flat for a long time, up until 22, where they dropped down about 40% roughly for the year. So a big drop in last year. But before that, incredibly stable. Revenue's been very stable as well. So we like that, because then you can say, well, if that should continue, and I believe it's going to continue, I can work out what my returns are going to be. That's the way we at TeamInvest look at things. Yeah. So ASX has some characteristics that we like. It passes nearly all our filters except for the debt, which has got about 350% debt to equity, which is very high. And the other problem with it is the return would be very, very low going forward based on its current PE of 36. So you've got a high PE, trailing PE, and you've got very, very low EPS growth. They don't mix. Right. Now, if it had 15% EPS growth, I'd be excited. Yep. And we've also got the double hit, as Grady mentioned, about the disastrous blockchain chess program, which management clearly looked like they were asleep at the wheel and really had no idea what they were doing and just assumed it would all be okay and contracted it out. They even bought into the company that they contracted to do it. Like, what's the logic of that, by the way?
Yep.
Yeah, that's like a hello. Anyway, now it's a total write-off and we're going back to square one. It's an absolute shocker, and they're going to have to spend an enormous amount of money now to try and upgrade what is a very, very overdue system.
And regulators have them in focus too.
Yeah, but even the way they handled that was bad. To me, the optics of all that, the regulators are saying this is really bad, and they'll say, oh no, it's not that, so it's no problem. You go, hang on,
you're running the market, and you're not taking it forward.
That's right. So you have a massively regulated support position.
Yeah,
that's right. So I wouldn't go near it. We're showing it returning between +3% a year to -3 margin of safety to default.
Right.
So you really that's not even inflation.
Right.
So why would you do it? I would say it's a sell.
Okay. All right.